Happy Friday, everyone, and welcome to another edition of Challenger Network News. I'm Brandon Bickler, partner at Elixir. Today, we're going to be talking about a very important topic. Companies are seeking new ways to create social and environmental impact more and more. And one key way to achieve this is through corporate impact investing, i.e. investing in game-changing innovations that are addressing challenges that are not only meaningful to their organization, but meaningful to society as a whole. Today, I'm absolutely delighted to be joined by Ken Gustavsen, Executive Director of Social Business Innovation at MSD. Hey, Ken, how you doing today?
Hey, good morning, good afternoon. Nice to be here. Thanks, Brandon.
Really good to have you on. Really excited about having a chat today. We're going to talk a little bit about the evolution of corporate impact investing from corporate social responsibility. We're going to talk a little bit about how MSD has developed your investment approach. And importantly, we're going to talk a little bit about how it complements traditional philanthropy. So are you ready to take on those topics with us today, Ken?
Ready, let's do it.
All right, let's do it. Well, great. Well, why don't we start off, Ken? Let's hear a little bit about the journey and maybe your journey. How have you kind of seen the evolution of CSR to start to include corporate impact investing? Maybe that's a good place to start.
Yeah, good place to start, Brandon. So I would say that maybe even to go back one more level, any company to exist is providing some sort of value to society. That's the enterprise value that the company is having intrinsically, which is why they operate. Beyond that, corporate responsibility or corporate social responsibility is when companies look intentionally at how they can do things quite often traditionally through grants and philanthropy and donations as a way to have a more direct social impact. It could be environmental, it could be social, depending on what theme they want to explore and what's aligned with the business. In the case of MSD, where I work, which in the US we're known as Merck, but in the case of MSD, as a healthcare company, we have for a long time, for decades, been involved with philanthropic initiatives that could involve donations of medicines, volunteering time, donation of expertise from the company, and financial donations to support healthcare and other sorts of needs throughout the world. And I think we and other companies will always do that. There's always a place for philanthropy and that traditional sort of corporate responsibility. But as you mentioned recently, there's been a growth of looking at how that same kind of social impact that you can achieve with traditional corporate responsibility efforts can be achieved in a way that could be a little bit more strategic and a little bit more sustainable. And impact investing is one of those ways. And maybe a simple way to look at impact investing is instead of doing donations or philanthropic investments, these are direct investments, as you said, into innovative or sometimes game-changing companies or funds, groups of companies that will intentionally have social impact as their mission. But because these are commercial enterprises, they are also looking at business success, which then allows the companies and in return the investors to experience a financial return on that investment, which is sustainable.
Yeah, so in a way, it's we've seen the rise over the years of corporate venture. It's certainly been on a meteoric rise in a way, and how that world has also interacted with the non-corporate or dedicated venture world has been just incredible, and we've seen the impact. We've seen the impact on business performance, businesses who are able to leverage new technologies to innovate and to drive new performance, and in some cases that even leads to acquisitions, new parts of their business that help spawn and create new commercial opportunities for the business. Has it been a similar type of rise from what you've seen on the social side?
Yeah, for us, when we look at impact investing, we look at three different pillars that an impact investment might be able to deliver. And one, of course, is the social impact, which for us is healthcare-related impact for underserved populations, traditionally in the developing world or emerging markets. Second is the financial return. Since this is not philanthropy, it's an investment, we're looking to see how that investment will return back to the company, some kind of financial return on investment over time. And then the third pillar is looking at business opportunity. So how can the companies that we invest in generate either direct or indirect business benefit? At a minimum, we're making investments in companies that will help to grow the healthcare ecosystem in these countries with populations that need a more enhanced healthcare ecosystem. And in the sense of a rising tide lifts every boat, that will be good for our business. In addition, there could be more direct business opportunities where a company in our portfolio might provide a partnership opportunity.
Right, right. Yeah, and it's that traditional partnership that we've seen where, corporates are looking for innovation to do things that go beyond what they can do with their existing resources. And of course, the innovators are looking for scale and distribution. And so that's why the partnership can make a lot of sense. I want to remind our people watching the show that if you want to ask Ken a question, just pop a comment in, and we'll be able to see you and ask your question on the show. So Ken, I imagine it probably wasn't super easy to get impact investing on the radar, and as something that the firm was willing to make a commitment to. And I say that because having talked to other businesses, I know a lot actually don't even have this type of setup yet, or some are maybe just starting to get it going. Can you tell a little bit about how you got it over the line, or a little bit of the backstory on that?
Yeah, so right, I wouldn't say that it was super easy because when we're making big commitments, we had to make a strong case for it. But the encouraging part about it is that since MSD has such a long history of doing things that have direct social impact with what we do, that the general perspective on doing something like this was very positive. And so in our case, it was a matter of being really clear to lay out the case for how this can enhance the type of social impact that we can get with our dollars, illustrating that there is a viable pipeline of investment opportunities that we can look at, and that these are investments that are viable, they're reliable, they exist in the places where we want to have an impact, and doing a lot of due diligence in terms of talking with others throughout the company. And because it really is it's a group effort that involves finance and legal and compliance and tax and other geographic parts of the company. And so we were challenged by our top management to pull together what the case looked like. And the good news is that once we did that, there was a lot of agreement that, yeah, this is a good thing to do, and we should do it in a very constructed and transparent way. So one thing we did is we set up an impact investing committee that consists of 5 very senior executives. And so whenever we're looking at a new investment or reviewing the progress of our existing portfolio, we go back to that impact investing committee that represents a lot of different functions and geographies of the company to keep us accountable and make sure that we're doing things in the right way.
And is there also one of the challenges we've seen more on the wider corporate venture side is sometimes the corporate venture arms, really been only kind of looking at the investment aspects, and there hasn't been as much engagement with the lines of business. People like looking to maybe leverage some of those investments to actually drive the business performance. So how do you get beyond that barrier as well, or have you benefited from the work that maybe your corporate venture arm had kind of established, or to help you with the impact investing side? Be curious to know your perspective there.
Yeah, for sure. Well, just from the approach that we take and the mechanics of making investments, since we have an internal team that does a lot of our, let's say, regular venture capital investing, that we're able to draw on that expertise and share best practices and use some of those internal networks, which has helped a lot to make sure that we're doing things in a similarly robust way.
And are you having to tap into new networks as well? Or I imagine like where you actually find these very promising targets to invest in are probably in some of the pools where maybe your corporate venture arm was already kind of investigating, playing, engaging in. But if you had to go beyond that and find new pools, find targets.
Yeah, so we've tapped into some external networks, things like the Global Impact Investing Network and others, where there are some like-minded investors, and also there are companies and funds looking for investors. So sort of a meeting place or a marketplace to make those connections. And there are several groups like that. A lot of it also is word of mouth. You make one investment and you make some contacts, and then you'll get contacted about some other investment opportunities that we also like to contribute to that ecosystem and pass on opportunities to other colleagues when we hear about them.
Yeah, that makes a lot of sense. I can imagine for anyone looking to kind of up their game in this space, these lessons are really helpful. And again, I encourage anyone who's interested in this just to reach out to Ken or myself, and I'll put you in touch. So let's talk about. So we talked a little bit about philanthropy and grants and that sort of world. So now we have this kind of complementary focus on impact investing. How do they live together? How do they coexist? Anything there that you can share?
Sure. Well, I've come from that corporate responsibility world most recently within MSD. And so they are part of the same broader organization that I'm part of. I'm part of a group at MSD called Social Business Innovation. And you can tell from the title of that group, what we're really looking for is innovative ways to have social impact in a way that's aligned with our enterprise business objectives. And so they're very, very different in terms of the tools that we use, one using grants and working with nonprofit organizations, whereas we're looking at investments into commercial opportunities. But the geographies may be the same in terms of areas where there are underserved populations that are experiencing certain health needs, or where there are opportunities to affect those health needs. So I think there's geographic similarities. There could be organizations that are involved in addressing some of the same health needs from both a philanthropic and from a business or commercial standpoint. A lot of times, interestingly, in some of the funds that we invest in, you see investor dollars that we might be putting in, but you also sometimes see complementary grant funding from other organizations that are interested in the same vehicle to have this impact, but they're not interested in getting a commercial return. So their funding can be catalytic, and usually called catalytic funding, so that you could have philanthropic investors alongside commercial investors that are both seeking the same thing. Now, we wouldn't do that. We wouldn't, as the same organization, provide both types of funding, but it's an interesting complementarity between grant funding catalyzing commercial capital.
That's very interesting indeed. And one of the things I know we talked about, a couple of weeks ago when we got the chance to speak, was just kind of who are the players you're seeing in this space. And it seems like, it's going obviously way beyond the health and pharma. It's going into insurance. It's going into basically probably every sector that's out there. And actually in places like insurance, we're seeing quite a strong history of venture investing. So it seems to continue to be growing and becoming more and more established, and therefore attracting better, more entrepreneurs, more companies, more exciting opportunities.
Yeah, the field definitely is growing in terms of what the opportunities are there, and that the engine is sort of creating those opportunities. And so you do see an increasing number of corporate venture capital impact investors like ourselves. You also see pension funds, whether from the US or internationally, who often have ESG, environmental, social, and governance mandates for the investing that they have to do. And so they would seek out impact investment opportunities as a way to fulfill those ESG commitments.
Got it. And we just got a question in, which I'll read out, and it was good because it's exactly where I was going to go next. Is what are the challenges? There might be some executives watching the show today who are thinking like, this is something we'd really love to do, but what are the challenges or some of the roadblocks? So why don't we take this question and maybe kind of talk about what are the kind of typical things that you've run into or seen others run into that can kind of put a roadblock in the way. So Sam's asked, when considering specific investments, how do you deal with the short-term versus the long-term trade-offs in terms of the financial return that you achieve through your investments? Have you put a price on social value in order to inform these sorts of decisions? Good question from Sam.
Yeah, good question. So there is a little bit of a asynchronous relationship between the timing of the social impact and the financial return, depending on the investment that you're doing. Typically, you could start seeing social impact very quickly, and you might not see the financial return until further down in the investment timeline. And so that's just an expectation to manage. And depending on where the money is coming from and how much you're putting in, making sure that it's very clear about when you would, if you would, see those financial returns compared to when the social impact would happen. One way to think about that is also the type of investment that you do, meaning debt versus equity. And if you have a debt investment, then you might start experiencing financial returns more quickly and in a more steady way compared to having an equity investment, which might be a more binary situation further down the line.
Absolutely. That makes a lot of sense. And then back to that, that's one of the, like you said, one of the trade-offs or things you have to manage. But have there been any kind of key areas that have posed a challenge to you or others you've seen trying to work in this space that really stand out?
Well, I think the first challenge would be what you raised earlier in our discussion, and that is just getting the internal endorsement to do this. Right. So, which department will do this? How will it be managed? How will the governance work for it? What kind of budget will you have, and how will the mechanics work? And there's a lot to work through that, which is grant making and philanthropy can also be very complex, but usually those pathways are a little bit tried and tested in the company. And so this is just a different path to forge. And so that needs to be figured out. Another challenge, which is a good one and more of a fun one maybe, is just identifying the opportunities to invest in and doing the appropriate due diligence to see if it's an investment that you're willing to pursue. And that can take a lot of work. One way to look at that and to potentially mitigate it is to determine if you'll be making investments into funds versus direct investments into companies. Funds are a little bit more straightforward in terms of you're investing in the fund, and then the fund will be making those direct investments into companies and doing the heavy lifting of the due diligence on those companies. Whereas if you're making direct investments into companies, it's a higher upfront due diligence burden to make all those decisions. And so that's a trade-off if you want to have more direct exposure to individual companies or get the built-in diversification with a little bit of a lighter touch that comes from making a fund investment.
Yeah, that makes sense. And so in both those topics, there's one size does not fit all. You've really got to kind of tailor your approach in a way that's going to work best for your business, both on the governance side and direct investment versus investing in funds. I'm sure there's a lot more to consider. Well, sadly, Ken, that's all the time we have for today. But it's been an absolute pleasure to have you on the show. And to only kick off this topic, I imagine we're going to get a lot of questions along the way as this show is reposted and republished. But it's just been a pleasure to have you on, Ken. And I have to say, I very much admire what MSD is doing in this space. It's truly impressive.
Thanks, Brandon. Thanks to you. Thanks to Elixir. And thanks to the audience. I'm glad we could talk today. I appreciate the opportunity.
Thanks, and have a great weekend, Ken. And have a great weekend, everyone. Until the next time on Challenger Network News, we'll see you next week. Take care.
Bye-bye.
Bye-bye.